The broadcast is now starting. All attendees are in listen-only mode.
Good morning, Jags. This is Fahad. Today is Wednesday, May 27th. Good morning, gang. How's everyone doing?
Doing good. How
Doing
you
great.
doing, Fahad?
Doing all right.
Good. Rise and shine. Okay. So yesterday the S&P rejected the 200-day, and today we are back above it. So there's a clear breakout. I don't think this one needs any more attention than what it is. We have an absolute clean breakout. Now, with that said, we need to be mindful of what's breaking out, what's really taking the rally higher, rather than just using a blanket statement of, that everything is going up, because that's not the case at all. And I've been pointing this out now for 2 weeks, that we are seeing a very expensive valuation multiples for growth stocks and extremely cheap multiples for the value stocks. In fact, the disconnect between the two had widened to 20 years, highest in 20 years. And that's why I've made so many different posts in chat room and webinar, Telegram, all different kind of places, that there's going to be a very sharp reversion to the mean between the two, where the growth will sell off and value get back, basically will rip higher. We saw first major sign of that yesterday when we saw VTV, Vanguard Value ETF, started to break out, and I think this one still has room to run up to 107, while growth sector, which I am looking at CLIX, it started to sell off. You saw the big bearish engulfing candle yesterday, but I'm looking at this morning in the futures, and we are seeing continuation of exactly the same thing. Russell 2000 index is up 2.5%. S&P is up 1.1%, but NASDAQ, where all the growth is pretty much flat, up only 15 to 20 points, only up 0.1%. So there's a chance that when the market opens, you're once again going to see underperformance from the big cap tech companies. Netflix, Amazon, Apple, Google, Facebook, all of them. They're going to probably put up some lackluster performance. Same thing with the software group. And then we'll see what happens with semis. That has some news this morning, so it could be a little bit positive for semis, but let's see how the day progresses. To sum up yesterday, here is a table that gives you what happened yesterday. And it's important, to be mindful of what's going on. We always tend to box ourselves by looking at simply sector performances and comparing one sector to another. And I always bring this up, that sector investing themes are different than factor investing themes. And sometimes you have to just simply change the ways you look at it to figure out, how to read the market. And take a look at this. This is as of yesterday. You saw value was up there all the way to the top, 1.5%, and momentum was all the way to the bottom. If you look at the qualitative side of how the market behaved yesterday, anything that is perceived as deep value, private equity guys are only interested in value. Buybacks only happen in companies that are considered deep value, right? Spin-offs and quality, they were all green, and yet IPOs and all of these other sectors that are considered momentum, they were at the bottom. Size and value, this is a much better picture. You can see mid-cap value up 3.5%, small cap value up 2.9%, and then take a look at what happened to growth. Mid-cap growth, small cap growth, large cap growth, grounded to the bottom. And this wasn't just yesterday. Take a look at the second table. You'll see the same trends, where the trends actually started to emerge really within the past month. However, if you go back to last 3 months, that was not the case. They were majorly underperforming. Take a look at the last table, for example. The growth was majorly outperforming and value was significantly underperforming. That started to shift in the last week to 2 weeks, and now it seems to be continuing in that direction. I have in Telegram, now let me close this out and let me just open my Telegram. I have this pin that I think worth mentioning. If it opens up in time, then I will let you know. Well, it's not opening up on my desktop. When it opens up, I will let you know what I see over here. But here you go. Hold on a second. This is the chart that I have been showing in Telegram for the last couple of weeks. And this is the level that shows the disconnect between growth and value. And each time when we go into a recession, you see a sharp reversal in the value stocks as they basically starts to outperform and growth continues to decelerate, or money continues to rotate out of it. The disconnect is so wide that at the end of April 30th, we were at the 20-year low. You had to go all the way back to 1999 or 2000 to see how cheap these growth stocks were. So just basically highlighting the same important trends. Now, with all of this said, some of this growth or some of this value investing. Now, my favorite right now is industrial defense. As you saw that I issued a trade idea to buy Raytheon last week. By the way, this stock is powering higher again. It's up another $3 in pre-market, and now it's going to open at 67. Yesterday in webinar, we talked about buying Lockheed Martin call options for the same reason. That stock in pre-market is gapping higher by another $3 or $4, and I think that's going to start to break out from this downtrending resistance, and I think we're going to see this thing make a run towards 400. General Dynamics broke out yesterday through $140, and I think that's going to go all the way to 160. Northrop Grumman, in which Jay presented a fantastic bullish idea on homepage recently, and I think this one is going to break out. Chronicle recently talked about UPS, and I think that sets up because transports and industrial cyclicals are the ones that's my focus right now. But what's also happening during the shift from growth to value, you're also seeing a lot of that value investing moving into most distressed parts of the market. For right or wrong reasons, it is yet to be determined, but it's also moving into a lot of those most distressed parts of the market. So for example, yesterday in conversations, I talked about casinos, and I was specifically focused on Wynn and LVS because these stocks did not run like Penn as well as ERI when they started to open their casinos. But then, and I mentioned this, that there is a plan in place where all of these casinos, particularly Las Vegas Sands and Wynn Resorts, they're going to propose to the Nevada Gaming Board by June 4th what their plan is to reopen these Las Vegas casinos. And if successful, if they can figure out the differences, most likely these Vegas casinos will start to open up by the middle of June. I mentioned this yesterday, and then yesterday we talked about in the chat room that we started to see next week's 87.5 call buying, the June 5th weekly 87.5 strike call buying. And so this stock is gapping higher by $4. Wynn is gapping higher by $4. So they were out of money yesterday, and they're in the money already in pre-market this morning. And these calls are going to be up 50% from those buyers yesterday. And the stock is going to be attacking this $90 resistance when the market opens. And that's going to open this up into this air pocket that's all the way up, all the way open to $103 per share, which would be the first technical target if it continues. So there is Las Vegas Sands, there is Wynn, and Las Vegas Sands has very much the similar kind of technical structure in play as well. So a lot of this growth to value rotation is finding itself basically going into these spots as well, where things are actually opening up, and maybe there's going to be some light at the end of the tunnel. All right, so here's Las Vegas Sands. If it starts to break out through 50, 51, which it's already doing in pre-market, that opens the door in short term for up to $54 per share, and I think that may get there today. Now, staying on this path, I saw this news yesterday, and this is from Houston. Houston hotel occupancy is slowly growing, but is far from back to normal. This was published yesterday morning, in which the main big hotels in Houston, big city, they talked about that the occupancy was down as much as 90% in some of these hotels, and now it has gradually improved to like, it's still down like 70 to 75%, but people, both recreation as well as businesses, they are gradually starting to come back to stay in these hotels. And then similarly, Wall Street Journal also over the weekend talked about hotel occupancy ticks up as weekend trippers hit the road. We saw a lot of this. There was a lot of news flow around the Memorial Day weekend that talked about that the hotel occupancy started to improve sequentially, really from middle of April. But then when the Memorial Day came in, we saw a huge jump, and it seems to be holding well since then. According to Wall Street Journal article, the occupancy rate is still down about 65%, but that's a sequential improvement from being down 90%. And then Bank of America, which is out a similar view, and they discussed this over here. This was before Memorial Day on May 20th last week. And they said that the April international RevPAR is bottoming out at the record lows. And so they also talked about, in this case too, that the hotel occupancy rate was down 90%. And now they're seeing that to be down about 60 to 85%. So basically some improvement there. And who knows that by the time June comes around or July comes around, hotel occupancy rate could be down only by like 50% or more. So sequentially improving, but year over year is still down a lot. You can look at some of these charts, how hideous, how bad these charts look, but perhaps sequential improvement to appear starting from May in some of these charts, Europe, Americas, Asia, and so on. So continuing on the same path, now what is that telling us about Marriott in that case? Marriott has the same exact kind of technical picture as some of those casinos that I talked about. They started to break out yesterday, right? And there was a bull flag breakout from Marriott yesterday. And this too is entering into a major air pocket here that's open all the way up to $117 per share. Is it going to make it all the way there, which is also the 200-day moving average? We have yet to keep in mind. We have to watch it. But I'm looking at pre-market action. The stock closed at $94 and change yesterday, and it's gapping higher at $98 and change in pre-market. So it's going to open up near yesterday's high, or actually above yesterday's high. And then this could run. And I'll be watching if it's going to see any kind of pickup in short-term call option activity when this happens. So there's Marriott, and then similarly Hilton Hotel, which still has some room to run up to 92. And then we'll see Choice Hotel and some of the other hotel chains could also see some spark over here. But Marriott is the one that I'm watching closely. So I'm just putting pieces together. There is definitely clear change after Memorial Day that a lot of these value names that got destroyed during coronavirus. Perhaps at the end of the day, there's a light, and they're gradually starting to make a comeback. By the way, Disney is also gapping higher in pre-market, and you can also put this in the same club as recreation stock. Now stock is at 124 after closing at 121 yesterday. Disney today will be providing its update to the Florida governor and the state authorities reopening plan, how they're going to go about it. And so we're going to hear that once that plan eventually comes out, sometimes in the middle of the day. But for now, the stock is gapping higher by $4, and we'll see how far this thing goes, maybe all the way up to 128 to 130 before we'll start to see some resistance. So that's what I'm seeing on my end. And by the way, guys, did you see this tweet from Donald Trump this morning? Anyways, if you did not, he tweeted this at 7-Eleven this morning. Republicans feel that social media platforms totally silence conservative voices. We will strongly regulate or close them down before we can ever allow this to happen. This was after Twitter added new section below Trump tweets in order to validate a lot of his claims, whether they're false or they're true. I don't know if you've been following the story or not. And so shut them down, really? I mean, come on now. So anyways, Twitter is not acting well in pre-market. Twitter is down about 2% in pre-market after the tweet comes out from Donald Trump. Facebook is probably also going to see small pressure, but I think this is all just noise. You can't shut them down, these social media properties. It doesn't work this way. Private enterprise, you can't just shut them. This is not China, this is America. Anyways, I just wanted to talk about this real quick. Avo, what's on your watch list?
All right, simple one. Oh, first of all, I wanted to update URGN that I spoke about yesterday, URGN. There was another lot of buying yesterday in the same November bull put spread. There was another 250 contracts added to, yeah, you can see it there.
Yeah,
The
right here.
25, 35, and sold the 20 puts to open.
Yeah, so somebody keeps building that bullish risk reversal position out in November.
Exactly. So for
Okay.
today, I'm just looking at LPX Louisiana Pacific. There was a buyer of just around 700 some odd November 25 calls yesterday, which are now in open interest. And just looking at some lumber pricing, which has gone up recently. And I see a lot of people doing renovation, construction on their homes and fencing, what have you. People are at home, forced to stay at home. Well, they're not forced to stay at home, but they're not allowed to go to work, and money is being poured into their pocket, so to speak. So they're renovating their homes. Good for them. In the past two reports that I see here from RBC Capital, lumber has increased the first week. So May 17th, lumber increased $12. This is single, I think it's plywood, SPF. So $12 week over week to $358, and the week after, so this will be the latest, it increased another $9 to $367. So I think if you also look at the housing stocks like Toll, oh, sorry, it's LPX, it's not. Oh, yeah, all right. So you're looking at LBS.
Yeah,
So
I'm looking at the lumber length futures. Just be
yes,
mindful, there's a lot of confluence of resistances there on the random length
there is
lumber.
even on LPX. If you look at the chart, it's butting up against the 200-day, which is a 50-week overhead. So it needs to be mindful that there is likely to be some sort of a push-pull here for a little bit. But if you look at housing stocks, they've done well. They've gone above this average. Technically, they've moved up. Toll, yeah. Well, this one not so much this one, but there's the DRH that we also look often. So this is what I'm looking at today. And,
Chronicle, Chronicle, you were also talking about LPX briefly in our internal chat room the other day, and you had some positive thoughts in this one too. Do you have anything to add here?
Yeah, I suggested this, I think, for the quarterly outlook as well. I'm still bullish. Nothing's changed.
Okay. So we'll wait until you have more fundamental color behind this. So I'm always excited when two of my guys work independently with, and then come back with the same conclusion and then find themselves with common ground. It's always exciting stuff. Jay, you go next. What do you have, buddy?
So today I have animal health. Stiefel was out last night with a note, an industry note, where they spoke to 100 vet practices across the United States. And it should be noted that today, starting at about 9 o'clock Eastern, they are hosting their Jaws and Paws conference. So we'll be getting a little bit more color on the industry there. I'm not sure who's speaking, but I would assume it's, your typical IDEX, Zoetis, and others. So now back to the survey. Their diligence highlighted how the companion animal market has basically remained resilient through this whole COVID-19. Among their 100 vet practices, 99% of them said currently open and 85% accepting wellness visits, and almost all of them, or the rest of them, are beginning to accept wellness by the end of June. And to their surprise, their work suggested that 59% of the practices that are currently open, they never stopped accepting wellness visits. And this correlates to the business update that IDEX Labs posted last night, in which they said, we continue to see meaningful improvement in U.S. clinical visit trends across all major regions, and how their overall clinical visits, non-wellness, and wellness visits surpassed prior year levels in the most recent week, ended May 22nd. So, positive on IDEX there.
So just 59% they believe that things will be back to normal by July. Did I hear that correctly?
So 59% of the practices that are currently open right now, they never stopped accepting wellness visits.
Okay.
And then, yeah, go ahead.
So the number could be as high as 80 to 90%, returning back to normalcy by third quarter potentially, right? Especially if
At
we
the end
keep
of June.
opening up.
Yeah, at the end of this month. And then lastly, on Zoetis, their Simparica Trio tablet that was approved by the FDA at the end of February, some positive checks there. Stiefel says that 58% of the vets that they surveyed were familiar with it, and actually that has increased since the beginning of the year. So, and this is important because when this was launched, this tablet, it came right around sort of the start of the U.S. COVID-19, and as a result, all the sales reps had to work from home. So that's a very positive sign. And then as far as the adoption rates for this tablet, 12% of the practices have already purchased the Trio, with another 6% expected to purchase in the next few weeks, and then 25% more practices purchasing in the second half. So you're looking at a total near 50%, somewhere between 40 and 50% adopting by the end of the year.
Okay, so that tells me one most important thing, because that tells me they're taking significant amount of market share from NextGuard and all those other competitive products that have been in the market for many, many years. And that's the thing we have discussed multiple times about Simparica ever since in December when we started to follow this story. Right? Would you agree that
Yeah.
I think in the next 1 or 2 quarters, they're going to steal the market share left and right big time. This is very, very positive for Zoetis. I understand for a giant like Zoetis, Simparica, as in terms of total revenues, is only expected to do about $200 to $300 million this year, which as a percentage of total revenues is not a huge, portion, but it's a growth driver that was not there and potentially turns into multiple expansion, especially also considering that this is a highly, highly defensive name. I love this story. And I think now looking at this chart as you bring this up, this is at a buy point right here too, because where I have this red line drawn, this was a breakout level very recently on high volume, and it successfully retested that. I also am looking at this 2 months of very, very strong accumulation trends. Look at the VOP bars over here. So it becomes a very easy one to get long with hard stops, let's say around 122 to 123, because your risk is far less. And on the other hand, this could start to take a new leg higher and take a run towards new 52-week high. Impressive. Good stuff. Okay, Chronicle, what's up, buddy? What do you have?
Looking at a couple companies. Firstly, Tractor Supply. They provided an update on Q2, expecting record sales and earnings. They're guiding for EPS of $2.45 to $2.65 versus $1.77 consensus, with sales growth of high 20s percentage-wise and comps in low 20s. Considering the company withdrew its full-year guidance, and the stock had also been trading at a bit of a discount to the consumer discretionary sector, I think that sort of provided the fuel for the strong price action we see after hours. In fact, I'd argue that whether or not this is a discretionary name is up for debate, because a lot of Tractor Supply's products tend to fill a need rather than a want. I know we've talked a lot about this company in the past. This has been one of those sleeper names where all of their stores have quietly remained open with growing comps, as well as management saying their e-commerce options have experienced substantial growth quarter to date. Going forward, it looks like the stock is about to open at an all-time high. Do I think there's room for more upside, or is it already priced in? Near term, I think Q2 has been priced in because management has just let the cat out of the bag. However, I do see a lot of upside potential for Q3 and beyond, particularly if management follows through on their plans for more product variety and assortment, bringing in exclusive brands, plus adding 90 more stores this year. So should we be chasing this breakout to all-time highs with Q2 already pre-announced? Probably not, because the right time to buy in anticipation of Q2 was probably around $80 back in April. But if the stock ever pulls back to 100 to 110, I'd probably be a buyer in anticipation of Q3 and Q4 numbers. A couple of price target revisions to the upside this morning. I think Baird and Piper Sandler have $130 as their target.
Good stuff. I did see that earnings report last night, and wow, what a blowout quarter that was. 20 in the sub 20% comp store sales growth online. That's just crazy. I've never seen a print like this from Tractor Sales. However, Tractor Supply, I do want to point out one thing, aside from what is obvious, which is the chart is overbought. MACD and RSI are overbought, and I think the stock could use some weakness. Keep in mind, this is also a growth name, so it's going to possibly get lumped into that whole factor rotation category. But we have noticed in this earnings season where those businesses that were considered essential and they were remained open, they all saw very, very strong earnings, and yet their stocks acted very weak after they reported earnings. So Walmart faded after the company reported earnings. Target faded after company reported earnings. And we saw some of the other ones. Costco has yet to report, but some of these businesses were considered essential. Let's just take it one day at a time, see how the stock technically reacts. I'm just not excited about chasing it here, and I think
I completely agree. I wouldn't be chasing this breakout. If it pulls back to VOP around 100 to 110, I'd be a buyer.
Yeah, sounds good. Okay, thank you everybody for joining. Good stuff. Folks, I just want to emphasize once again, there is a serious growth to value rotation going on. Now, my focus is industrials and transportation to play those trends, IYT, for example, and XLI. But make no mistake, a lot of this value money is finding itself into the lodging companies, casino companies, airlines, which saw sharp call buying on Friday as well as yesterday. And so it's finding a lot of this into those areas as well. That's it from me. I'll see you guys in the chat room shortly.